Financial planning and security can sometimes be seen as a moving target. The rules change constantly, and you need guidance to stay ahead of the market moves. This is the Lebenthal Report with Michael Hartzman and Dominick Tavella. We'll break down the news, trends, and overall direction of the markets, telling you what may be coming next, investment opportunities, and what to avoid. Now, here are your hosts, Dominick Tavella and Michael Hartzman.
And good evening, everybody. I am Michael Hartzman. Today is June 8th, 2021. And as always, I'm on with my partner, Dominick Tavella. Good evening, Dom.
Good evening, Mike. How are you this evening?
I'm good, thank you. How are you?
Could not be better. Grateful to be able to be on the show this evening. It's a little bit of a long distance interview tonight, but I am definitely looking forward to our guests. So this should be a good one for us.
So for the benefit of our viewers and listeners, since you said that, Dominick is broadcasting today from Italy, which is, I guess, more proof, Dom, that the pandemic is getting further and further in our rearview mirror. Because you did say to me, I am getting on the first flight I can. And I think you literally got on the first flight you could.
Pretty close, Mike, but if we could just get serious for 1 second, I think it really talks about how the world is changing and how COVID changed how we do business as a country, as a world, the population, how we can function from anywhere in the world. I think this is proof positive of it. And boy, we're putting it to the test, but we've had other guests from international locations, but here we are as if we were literally in offices next to each other and still able to work.
It is amazing. And your voice is coming through in real time. And you're right. Back in the winter, we had Jim Rogers broadcast from Singapore, and we were going to eat our dinner and he was going to have his breakfast. So, and that went seamlessly as well. So you're right. The pandemic was certainly tragic and certainly, devastated a lot of lives for a lot of different reasons, but there are some slivers of good that came from it. And from a business point of view, the technology that was always there that no one ever used really came front and center. You could not be more correct about that.
Yeah, and one of the things I'm really looking forward to speaking to our next guest about is this idea that the world is also starting to open. They are quite a bit behind us in terms of vaccination rates, the population, the ability for restaurants and factories to open. They are quite a bit behind us, but they are catching up, and the world will catch up, and the world will open up. And one of our themes over the last couple of weeks is we made a pretty decent investment in the international sector. I hate to say this is proof positive, but my being here and witnessing where this country particularly is and Europe particularly is proof positive that the world is really starting to come out of this.
Yes, and our guest this evening is Dr. Quincy Krosby, the Chief Market Strategist at Prudential. She is certainly a friend and a great advocate of ours, and we're thrilled to have her this evening. And she's gracious enough to really spend the duration of the show with us for 45 minutes. And I was fortunate enough to be on a call with her. I think it was probably February or March, maybe it could have been January. And she said then, these vaccines work. These vaccines are effective. America is leading the way, and we will be somewhat back to normal by now. And she was spot on. I mean, she knew it then, and here we are, as you said, living through it, and it's happening.
Well, I'm really looking forward to hearing from her this evening, and hopefully she gives us some additional insights. But again, the U.S. economy is really starting to get on a roll. Number of new job creations, number of new jobs opening is just, they're fantastic numbers. We still have quite a few hurdles to go. But my focus over the last couple of weeks has been on the international scene. And I think the fact that they are somewhat behind us gives us an opportunity to get in a little bit early and maybe take advantage over the next 3 to 6 months. So I am very much looking to have this conversation.
So am I. And the other thing that I want to ask her about is I was reading a report that came out yesterday from JP Morgan, and they were also talking about how the value trade still has a lot of legs to it as well. And we talk about on this show every week how value has really outpaced growth so far this year. But believe it or not, the earnings were much better for the growth sector than the value sector this last quarter, primarily because the value sector, the airlines, the energy companies are still licking their wounds from the pandemic. So their earnings are going to improve. And JP Morgan thinks, like I said, that the value trade still has some legs. So I'm really curious what she thinks about that as well.
And Mike, this is a theme that we've gone over quite a few times over the last weeks and months, but NASDAQ clearly has underperformed versus the value sector. But as you just mentioned, earnings were pretty good, right? You didn't really want to sell out completely. For us, it was always this theme of rebalancing, of shifting where our eggs were concentrated last year to the value sector. But we didn't abandon the large cap growth sector. We just lowered our exposure. In fact, harvested some profits. So I'm very much interested in her thoughts, interest rates going forward, inflation going forward. I think we have one of the premier experts in our industry. She's been brilliant with some of her calls in the past. And again, I'm really looking forward to this conversation going forward.
Yeah, so am I. And we teed her up. And you're right. The last thing we're going to ask her about are the two I's, which are on everyone's mind: inflation and income taxes. So we'll keep her busy for 45 minutes. There's no doubt about that, because those are the two things clients actually ask me about. What are they worried about? Inflation and income taxes.
So on that thought, I think we're almost ready to take a quick pause and introduce our next guest.
All right, we will be right back after this.
Financial planning and security can sometimes be seen as a moving target. The rules change constantly, and you need guidance to stay ahead of the market moves. This is the Lebenthal Report.
We have Carrie Short, the Regional Vice President from Prudential Annuities, with us to introduce her colleague, Dr. Quincy Krosby, the Chief Market Strategist of Prudential. So Carrie, thank you for jumping on with us, because I can never give Quincy the proper introduction like you can. So I'll throw it over to you, and then we'll let Quincy have the floor.
Thanks, Michael. Always good to see you and Dominick. So appreciate the invitation to join you all this evening. On behalf of Prudential, and specifically Prudential Annuities, sure hope this finds you guys and all of your clients doing really well. And I'm equally as excited to get out and a little bit more back to normal. With that, it's my pleasure to introduce Quincy this evening, and I'm going to do so by reading a formal bio, because she's got such a fantastic and varied background. Dr. Quincy Krosby is Prudential Financial's Chief Market Strategist. In this capacity, she provides a perspective on the global macroeconomic environment and financial markets. Previously, Quincy was the Chief Investment Strategist at The Hartford and Global Investment Strategist at Deutsche Bank Asset Management. She also had global markets positions at Credit Suisse and Barings. Before going to Wall Street, Quincy Krosby was a U.S. diplomat, serving in Washington and United States embassies abroad, including a posting as energy attaché at the U.S. Embassy in London. In addition to numerous assignments at the U.S. Department of State, she served as Assistant Secretary of Commerce and represented the United States to the International Monetary Fund, positions which require confirmation by the U.S. Senate. Quincy studied at the London School of Economics, where she earned her master's and doctoral degrees. She's frequently quoted in the financial press and appears often on business television. And with that, Quincy, it's always so nice to see you. Thank you for joining Dom and Michael tonight.
No, thanks very much for inviting me. I appreciate it. And Dom, I want to just mention, Dom is in Italy. And, I just want to mention because we're talking international, Italy has a president who was the head of the European Central Bank, Mario Draghi. And Italy is moving in a direction of much more of a, how shall I say this, business-friendly environment. And it's been showing up, I think, in some of their in their stock market, the kind of changes he's able to put forth. A very important change. Italy is a very big economy, and it matters for global markets. So I just wanted to make that clear. What we are seeing, and it's important, is the beginning of a synchronized global recovery. which is extremely important because when you look at that, you always want to see the global economy working together as opposed to some parts of the global economy under tremendous stress. By the way, I mean, COVID is still out there. You look at some of the countries, just for example, in emerging markets, look at Vietnam. Vietnam did a great job in, locking down, keeping the virus at bay, but they haven't been able to really engineer a major campaign with vaccinations. That's important. We can't forget that COVID is still there and vaccinations matter. And I mentioned Vietnam because it's actually a very important component of the emerging market landscape. They manufacture quite a bit for the West, but nonetheless, they are going to be able to pull out it. That's why when we talked about this back in December and in January, we knew that once vaccinations came on board and once there was a campaign, normal life, the tunnel towards normalcy would be clearer and clearer. The light would get brighter, and it has as we speak today and realize that we're all making summer plans. And Dom took a flight to Italy. Italy, by the way, just so we remember, when COVID started here, when we knew about it back in March a year ago, do you know, for the stock market, we would follow what was going on in Italy. Why would we? Why would that affect our stock market? Because we knew there they were, the first European nation to be really, really hit by COVID, that we could see the same exact thing here in the States. And on the other side of that, as Italy started to conquer COVID, we started to see, yes, it's possible. So there you are. That's how well we are linked. The markets here in the US right now are still just inches away from their all-time high. And are they going to get there? Are they not going to get there? Look, we're kind of patient. This is a interesting period for the market. And, I don't like to say it's different this time because I can tell you those words are dangerous for anyone who says it. Why? Because it's never different this time. But honestly and truly, different this time, coming out of a pandemic that shut us down, shut the world down, it is different this time. The economic landscape is getting better and better and quickly, very, very quickly. Dom mentioned the number of jobs that are open. It is actually making a record over 9 million. The question then becomes, do we have enough people to take these jobs? And this is important because we do watch to see whether or not the economy, the service part of the economy, manufacturing has been doing very well, by the way. New orders have been up, hiring expectations have been up. But the service part of the economy, which, by the way, is 2/3 of our economy, that's right, 2/3 of American economy is the broad service sector. That is healing too. But the area where we need to have workers come in is in small business owners. Today, a report came out from the National Federation of Independent Businesses, extremely important survey that we get every month. And what is their biggest concern? Having workers. And being able to pay them and be competitive to have the workers come in. But the demand is there. But the supply of labor, alas, we have a lot of people still home. This is a very big issue. How are we going to solve this? Well, first of all, even where I live, which is fairly rural, the McDonald's nearby is offering a signing bonus. I saw one in the internet, they were offering $500. Here it's a little bit more modest, but you can see the issue. They need to have workers because Americans are going out. They're going out much more. And we saw this when folks were going to Florida, as people were saying, you know what? Why couldn't we go to Florida when the kids are off from school or during the spring break? They went, but what they discovered was high prices, long waits to check in, and the need, it was obvious, the need for more workers. So what's causing this? What's causing it is a number of things. One, Americans are being treated very well by the government. Extra $300 a week, a stipend, That ends actually at the end of the summer. But many people are just saying, I'm still worried about COVID. Many women, moms, are home because their children are still home. The thinking is that by the time we get to the fall, when kids are going back to school, when childcare is available, they will be able to go out and join the workforce. And again, it's important because you heard them folks talk about inflation. The thing that we're watching is wage inflation. Are wages going to stay up higher for much longer? We just don't know. But one thing we do know is that 25 states in the country have actually cut that stipend, that weekly stipend from the government. They want people to go back to work. So the more we have of that, the more also that we have of the supply chains. How many of you have said, I went to Lowe's or Home Depot and I ordered a vanity, right? I can say it because I did. Quincy, you have to wait weeks and weeks. And I'm like, what? I thought that you had it here. No, we don't. We have to order it. Supply chains are broken. But as these supply chains are being fixed, what we expect to see is that prices are going to come down and the supply to you, the buyer, will be much quicker. This is going to help the overall environment and the economy. So the market, now please remember something, this is absolutely incredibly important. The market is not the same as the economy. Sometimes it seems that way, but it isn't. And the market looks ahead. Who would have thought that we would see those big growth names, big tech, do so well after March 23rd, 1 year ago? No one thought that. No one thought it was even possible that the market could even move higher. But thanks to the Federal Reserve, and at that time it was the Trump administration, we were able to have a low in the market. That was March 23rd of a year ago. And we started investing. And then along came research for treatments, and also most important for vaccines. And we knew, despite the awful numbers in data, the growth domestic product, GDP, the labor market is so awful, we started to see hope and we started to invest. So where we are now is we have a market that is pretty rich. It's kind of expensive. You want to see some pullback, but what matters very much is the Federal Reserve. And we'll talk about that later. But why do I mention it? Because the Fed is meeting next week. And it's probably one of the most important meetings we're going to have over the last number of months. The Fed has been keeping this market liquid. It's been keeping rates very, very low. We want to see what their plans are. Those plans matter to everyone in this country, but also global markets. And we could talk about that later too. We like the market. We're pretty happy to see a market that's kind of quiet, that's kind of flat. Nothing wrong with the flat market. But what we are looking for is what's next. Do we get the agenda coming in from the Biden administration in terms of infrastructure? That's going to affect some of the areas we invest in. And does COVID stay on the sidelines? Because that affects so many of the places where we invest as consumers. So all of this matters. But right now, things look pretty good. Thank you.
Thank you.
Thank you, Quincy. Michael mentioned it just a few minutes ago that we get this question all the time about inflation, and obviously it seems to be the topic du jour every network, and our expectations, the market expectations, that we're going to see significant higher inflation as we go down the road here. But is it possible, some of the things that you mentioned, the fact that the labor force hasn't come back in full force, that we have clogs in the pipeline, so whether it's new home construction and other events can't quite, auto production can't quite get up to speed. Is it possible that the byproduct of some of these problems that we're having right now actually keep inflation in check for a little while longer?
Well, yeah, absolutely. I mean, the debate over inflation, I call it the inflation wars, basically is based on this. One side says, hey, you know what? The higher wages are going to stay there to a large degree. The supply chains, yeah, they'll be fixed, but not really. Prices, once they go up, they don't come back down. And, and inflation can be sticky. It can be sticky because if we're willing to pay the higher prices for airline travel, for hotels, they don't like to count food or energy, which, I won't get into debates about that here. We don't live in caves, but nonetheless, what we are seeing is that prices are up. The question is, are they temporary? As the Fed likes to say, transitory. Do those higher prices stick? No one is suggesting, by the way, even in the people in that camp, that inflation is rising, that we're going to have the kind of inflation we had back in the late 70s and 80s. We bought a house. I'll never forget this. Our mortgage was, I think, 13 or 14%. And people thought, oh my gosh, how did you guys get such a great rate? Did you know someone at the bank? Imagine 13, 14%. But here's the point too, and this is on the other side, the Fed side. And by the way, there are people on both sides who are very, very smart. On the Fed side, their view is this: the supply chains the obstacles are being unwound. That's going to help. Lumber prices are down, in case you haven't noticed, for a variety of reasons. I could go over that later, but that's one reason. So they say supply chains are easing, they're opening, they're normalizing. Then they also say, look, we still have millions of people who are looking for jobs, millions of people who are unemployed. We need to get them back in with jobs. And then their view too is that there was that the economy, once we're through all of this, needs to consolidate. That we've had just abundance everywhere, and even before the pandemic, we needed to see consolidation in many areas. Then they also point to back to the labor market, which is a crucial part of the inflation story. You don't have unions very strong. Back in the late 70s, early 80s, unions were very powerful. They got higher wages, they got benefits, and then the rest of America actually also enjoyed that. So we don't have that now. That's also, and technology. Technology is being introduced into so many areas in the manufacturing process, in the service sector, that also is going to help keep inflation at bay. But you know what? We have to live with this inflation debate because we won't know for a while. And the Fed, and this is important for the markets, the Fed has been buying $120 billion every single month since the crisis began of mortgage-backed securities, yes, to help the housing market, and also treasury bonds. 40 billion of the 120 billion is just for mortgage-backed securities. The question becomes, when do they slow down the pace of these purchases? When do they start talking about it? And what we're hoping for, or maybe not hoping for, is that in the discussion for the Fed, we get the statement next week that perhaps they say we have begun the discussion for what they call the taper. But the one thing that I can say, they do not want to see financial conditions tighten. When I talk about financial conditions, that is the number one thing that's important to all of us, because you know what it means? You still have credit. When financial conditions tighten, credit goes. We remember 2008, 2009. Remember your credit cards? You thought you had, I don't know, 500,000 on it, 20,000 on it. Suddenly it was cut. Credits got tighter and tighter. That's when we get a recession, when credit is cut. The Fed doesn't want to see that. So they're going to be what we call dovish, easy peasy. But the market is saying, aren't you going to slow the pace of that? And probably start with mortgage-backed securities, because the housing market has done so well. And many people have said it's not a good time to buy a house. We look at all the surveys. So this is going to be extremely important. The employment numbers are getting better, but they're extremely strong, but they're not stellar. That probably is also going to hold the Fed back a little bit. They want to start normalizing rates, of course, but they are going to stretch it out for over a year to 2 years. They want to keep the economy going and growing and as strong as it could be coming out of this bizarre period that we have been in.
So, Quincy, if the Fed is able to do that, as the expression goes, those interest rate increases will be baked into the cake, and the stock market should be able to absorb those Fed increases, because if the Fed telegraphs them, then it's not a surprise, correct?
Yeah. Exactly. And, there's so many ways that we look to see what financial experts or regular folks, average folks, think about inflation. Everyone thinks it's going to move higher and it'll be stickier than what the Fed actually is telling us. And the question is, I always say this, are the people at the Fed actually smarter than we are? Of course not. We know. And by the way, this week also, we have the consumer price index coming out. Now, keep this in mind, because this will affect the market. There is something called food and energy. That's the headline. We don't really pay attention to it because, after all, we don't eat and we don't have to worry about, heating or air conditioning. So then we look at the core, that's really what's most important. Now, here's the thing about the last report. Guess what pushed up the inflation picture? Guess what it was? Was it technology? No. I'll tell you what it was. It was used cars. Used cars have become so expensive that they actually pushed up the core inflation story. Now, is that going to stay like that forever? No, clearly not. There is a chip shortage, chips that are in every single part of driving. You name it, it's there. And there is a shortage. So because there's a shortage, many of the manufacturers have actually stopped manufacturing. Some have come back now. They've managed to find and source chips. These are the silicon chips. And that has made used cars, I think, as expensive as some of the new cars. It's sticker shock, but not for what's on the new car lot, but what's on the used car lot. That has an enormous impact on inflation. Here's another one I think that most people don't realize, because you know why? Because it's weird. That's why most people don't realize this. And that is, it isn't what I pay for a house or a condo that pushes up inflation. No, it is what I can rent it out for. It is called the owner's equivalency rent. That also has a very big play in the inflation picture. And that is starting to move up too. But I'm curious about the used car scenario when the report comes out in just a couple of days.
Quincy, again, you've mentioned it. I'd like to focus, if we can, a minute. So low interest rates have really created a housing, I hate to call it a bubble, but we've seen housing prices in parts of the country that have just exploded. And clearly they have cheap financing and a lot of liquidity in the economy. And you're looking at some of the price increases around the country, and you just have to shake your head and say, how long can it last? And I get it from clients, Michael, as well. Is this a good time to buy? Should I be buying, or should I be selling and maybe sitting on the sidelines a little bit? I'd love to hear your opinion on that subject.
Well, you're asking the right person, because we are going to be putting our house on the market fairly soon. And we hope that our house is one of those houses that people want, and that there's a bidding war, because that's what I see all over. But I will tell you that we saw mortgage applications were down. And we also saw the surveys on, is this a good time to buy? And that has pulled back too. If you noticed, home builders as a group are coming down in the market. So is it based on the fact that those who invest think that rates are going to go up, hence mortgage rates will go up? Or is it based on something else, that Americans are going little by little sitting back from this housing bubble that you say, and perhaps saying, hey, you know what, let's not think about it now. Let's take the family to Disney. Let's go on a trip. Let's just hold out, because watching the housing market is very important, because it tells us about interest rates. It tells us about availability of credit and consumer confidence. Those three are important for more than just housing. But housing has what I'm going to buy at Home Depot, what I'm going to buy at Lowe's. Also, we noticed that furnishings have come down too. So we're watching this very closely. Is it just a one-off? Is it that people finally are traveling and they're putting off looking for houses? Or is this the beginning of a pattern? The one thing about the housing market is this, that in terms of investing, is that investors have an antenna of, remember, they're not the economy, they're the market. They go in early, sell early or buy early. Are they seeing that interest rates are going to go up? And therefore, it could be 4 months that investors will move in one direction or another. This is important. We're watching it. And I'm in the category of, there's a part of me that gets very nervous, like, oh my gosh, I have to get it on the market very soon because it's making me nervous. But here's the problem I have that everyone has. The guy who's doing the tiling in what I'm calling a spa bathroom, I never thought in my wildest dreams I'd have a big soaking tub. We live in a house that was built in 1820. But the real estate agent said, Quincy, people coming up want soaking tubs. Oh, okay. So we're doing that. But the tile guy has like 4 other jobs.
Yeah.
I mean, and I'm like, I want a job like that. Show up when I can, don't show up.
Wait,
And
Quincy, you actually found a tile guy that showed up? And
he just showed up.
really did the job.
Exactly. I'll give him your
That might be
number.
the best kept secret of the entire show.
Yeah. Then don't tell anyone where I live. They could put cameras out there and see who's coming up with his truck. But he does show up. But then he'll even say to me, oh, Quincy, someone asked me to do another job. And I said, okay, his name is Fred. I'm saying this. I said, Fred, I'm begging you. I beg, you've got to finish the job. I don't want to miss the selling season. So that's the point. I don't want to miss the selling season. Yeah. And if rates go up, look, I even said we paid 13-14% on our first house. This is before we went overseas. But you can't tell someone, oh, if mortgage rates go to 4%, why are you complaining? It's because they live in the here and now. They're not comparing it to where it was for us. Because people always say, well, why are they complaining? Because they're used to low rates. So look, I'm keeping my eye on it. I'm watching it because it is a very important signal. Now, I'll tell you what is moving in terms of real estate, REITs. REITs have started to come back, and REITs are leading in the market because, and it is interesting because in normal times, REITs and energy tend to be late cycle. They tend to signal to us that we're entering into a later cycle. But again, it's different this time. So what do we watch? We watch whatever the consumer is doing because we know consumers are savvy. If oil prices go up too much too quickly, we hold back at the pump. We hold back other spending. And if we start to see rates moving higher on our credit cards, because people look at that, we start to hold back. So the question is, can we get some more out of the business cycle? And we think that we can, because it is different this time.
Quincy, could we just shift gears for 2 seconds and talk about the other I that I mentioned in the open, and that's income taxes?
Oh, yes.
And you being having worked in Washington, I think you're one of the few chief market strategists who really got an inside look at how Washington operates. So that being said, if the Democrats actually eliminate the step up in basis and actually make capital gains the income tax rate, do you think they realize that these are devastating maneuvers for the middle class, and it's a good negotiating ploy? Or do you think they're determined to really, enact these things, and do they understand the unintended consequences these maneuvers might have?
Yeah, they understand it depends on whether we're talking about the progressive wing of the party, whether or not Biden has moved to them so that they're placated. Many thought that he was coming in as a moderate and would keep them at bay.
Right.
The question then becomes the negotiations, because everyone knows the capital gains. What was the date that was put on that? It was April. And people are like, what? Can they get away with that? We're going to see. We're going to see, because it's all about horse trading. Everything in Washington is about horse trading. It doesn't matter what it is. And also, we know that the Democrats have a very thin margin. a very thin margin. So we're going to see. I mean, we already know that he talked about the corporate tax coming down from where he wanted it in order to have the Republicans agree to the at least a package on the infrastructure spending. Now it all depends on whether that falls apart and they do it alone. Chances are they do it alone, and we'll see. And the question becomes on taxes, whether or not with that package, and they go it alone, do they come out in there with, hey, and this is how we're going to pay for it. If 400,000, we raise your taxes. We don't know. I think we don't know because they don't know. But they are intent on raising taxes. Does it make them vulnerable for the midterm elections? The party that is in power is always vulnerable. They lose seats. But then we'll start looking at 2024. It is, I don't have the words for it if it goes through, because and the reason is simple. The country is so varied. If you talk about 400,000 and your taxes are high, put it up there with the millionaires. In the Midwest, I mean, in some of the areas where it's you live like a millionaire, but it certainly isn't a millionaire income. If you live in New Jersey or Southern Connecticut or New York, you hardly have any money left over because the taxes are high to begin with in those states. So there's something about this which those who crossed the line to vote for Biden, who were Republicans, may find that, maybe they're going to go back to the Republican Party. The independents, for example, who crossed over, they may say, you know what, maybe I didn't like Trump, but if there's a Republican, maybe I go there. This is a very sensitive issue, very sensitive, because here's another thing. People don't know, is it 400,000 for a family or is it an individual? Right? That they never have clarified that. The capital gains is, I can't even talk about it. I really can't. What about small business owners?
Quincy, can I
what
just
about
jump
farmers?
Quincy, can I just jump in on that one?
Of course, yeah.
Literally hitting the nail on the head. And this is our core client, mine and Mike's. When you talk about that price point where they're going to go after people, you literally are talking about the heart and soul of small business owners in this country.
Yeah.
Pure entrepreneur that creates jobs, that creates value, that creates wealth. I know they keep pointing the finger at these mega tech billionaires, but they're really going after the heart and soul of the job creators, wealth creators of this country. They literally could be cutting us off at the knees in terms of growth going forward.
Absolutely. I mean, coming out of 2008, 2009, it was the small business owner that pulled us out. It wasn't big corporate America hiring. It was the small business owner. Small business owner actually was responsible for the majority of jobs for over a year until large corporations started to hire. It is, like I said, it's horse trading, but it's sad. Here's another thing. What about the taxing of dividends? When you have dividends, you're taking a risk. It isn't as if this is your income. You're taking a risk to be in dividend paying stocks, aren't you? Of course you are. And not only that, how many lower and middle income Americans have dividends in their portfolio? They may work for a company. They're the most loyal, by the way, who work for companies. They keep those stocks. Whereas the upper echelon in companies have a rotation of getting out of their holdings. But the employees hold on to that for dividends. And now you're going to tax them at a rate that is your income. It just, I'm not a policy person or a policy wonk. I'm also somebody who's going to be affected by this, and I don't like it. And this is why the Democrats internally are fighting over it.
So you just teed up my next question. You mentioned earlier that the Democrats might go it alone, but the Democrats can't go it alone, because I think there are enough moderate Democrats, and obviously Joe Manchin and Kristen Sinema come to mind, but there are others who I don't see how they get on board with this more radical progressive hikes that they're proposing.
Well, exactly. And, some of them are running for a reelection. They may be more progressive, but the states they come from are more conservative or more moderate. So that's the other issue that they have to take care of. Again, normally the party in the White House is going to lose seats. The question is, do they lose more than they had expected? Can they keep seats? A lot of this is going to matter, and you already see it in the news. I mean, I have to say I do follow quite a bit of it. Those who come from moderate states are saying, you are making us even more vulnerable than we were.
So Quincy, one more follow-up to that, and then we
Yeah,
can move
sure.
on.
Yeah.
It seems obvious to Dom and I that the administration is focusing on the reopening of the economy, getting the pandemic past us, and getting things back to normal, right? So although they use an April 1st date, the back date these rules, they still have a very small window, don't they, to get this done? Because to your point, they focus on the reopening now, and then suddenly in 2022, before you know it, they're going to be focusing on the midterm elections. So my hope is, because this window is so small, that they want to get something done, and they'll be willing to compromise as a result of that.
Well, yes, I agree completely. I mean, they're going to use reconciliation if they can't do it with the Republicans. We know that they will use that process. But as you said, they have to negotiate within their own party. If they can show that they were prepared to negotiate and it didn't work, perhaps the more conservatives in the Democratic Party will say, okay, we tried, it didn't work. It is, as we know, it isn't the standard infrastructure package that's the issue. It's the other part of the infrastructure package, the one that has social implications, the one that has been labeled the progressive part of the Democratic Party. That's the issue. And so, this is how they're going to have to negotiate it. But we'll see what happens. But the market this is, by the way, for the market, is look, anything that makes the economy stronger, anything that gives corporations higher revenue, right? Because at the end of the day, we look at top line revenue growth, that will supersede these taxes. I'm not so sure, quite frankly, but we'll see, because at the end of the day, we do look at earnings. That's probably it is the most important thing for markets. But you also have the taxes for corporations. Corporations, when we invest, we're looking at their margin. How much do they get to keep? What are they keeping? And we know that there may be that 15% tax, that too, the global tax that Janet Yellen negotiated. That's every country is going back now and having to negotiate, not just the US. Everything is a fight. I call it horse trading because that's what they used to call it, horse trading. But everything is subject to horse trading. There's no doubt. Yeah.
So Quincy, when we had the Trump corporate tax cuts, it was pretty easy to calculate out, well, this is going to be the average increase in bottom line earnings for each corporation. This is what the earnings on the S&P would look like. And obviously the markets had a pretty good year. It wasn't hard to say, hey, corporations were going to have a greater bottom line profit. A multiple reasonable would give us a pretty reasonable rate of return. What happens if we get a pretty significant corporate tax hike, lowering bottom line numbers?
There you go. It's going to be difficult. But here's where the parties are different. The Democrats, particularly the left of center Democrats, right, the progressives, from the get-go said, where's that money going? Where is the money going that the companies have saved? Where are they spending the money? And so they started to see, we saw a pickup in sweetening of dividends. Yes, we did. We saw a pickup in share buybacks, which is legal. Companies have been doing it for some time. And we know that just the mere announcement of a share buyback is going to help your share price. But then again, we also saw a pickup in capital expenditures. But the criticism about they made it sound as if it was, I don't know, un-American that companies were sweetening the dividends and share buybacks. In fact, the President Trump's chief economic advisor at the time answered a question from the press regarding all of this, right? And he got so angry with the question. It was almost, well, look what you're doing. This isn't helping any American. And he basically said, oh, really? Really? Anybody who has a pension is being helped. Anybody who is buying his company's stock is being helped. So he stood there and said, don't tell me this is not helping. Right? But nonetheless, it's presented as if it's only helping the very rich, like only the very rich. And that's where the class warfare comes in. Just what we talked about just a few minutes ago about, those who are going to be hurt versus those who aren't. It always comes down to the middle class being hurt. It always comes down to and they made the case, the ultra left of the Democratic Party. Well, this isn't helping anybody. Well, guess what? A company can hire more when they have more in their bottom line. I mean, they buy more, and when they buy more, someone else is manufacturing that.
Right. And they build factories and all that.
Exactly. It's, it's very difficult to talk about this. And then you get labeled, are you a Republican? Are you a Democrat? And I say, no, I'm an American. And my job is the fabric of the market, is what companies are earning, what they're earning and what they can do with that money. Can they hire more people? Look, I'm all for companies paying people more money. That helps. It actually does help. Having wages go up, they can raise their prices a bit, wages go up a bit. We're not talking about hyperinflation, but the point is,
see household income go up for the first time in a decade.
Absolutely. People haven't been spending money.
Right.
They've been home. Yeah, we've been ordering online, of course, but the stock market has helped. The housing prices have helped. The question becomes, really, when we distill it, is this too much of a good thing? That's the question regarding rates, inflation. Is this too much of a good thing? Is this ultimately going to lead to inflation rising too much? And if it does the Fed then have to tighten more and more quickly than what they have proposed? So this is why this meeting coming up is important. If they start to talk about, they've been out talking about it, suggesting to us or me that maybe they want to say, yes, we're not talking about it, we're discussing it, because there's something else I want to add here. The Fed changed their mandate. So it's always been inflation, keeping inflation at a level that doesn't hurt the economy and doesn't help the economy. It's neutral. And they have always had employment, to have rates at a level that helps the economy and helps to create maximum employment. That's what we've always known, right? But they changed it. They changed it to say, and it's become official, that the employment mandate has been broadened. And it's been broadened in this way. They don't want to start raising rates until everyone who wants a job, who has been let go, is able to get a job. And they say minorities, women, anyone, any low-wage earners. We do not want to start raising rates that could tighten conditions, tighten the economy. And these folks have not come in to the labor market. We want to wait until they come into the labor market. So all of the concern, and I wouldn't say it's concern, but understanding what the Fed's thinking is, has been not hampered, but it's all of us understanding what happens if inflation rises too quickly and the Fed has not had that mandate fulfilled. Do they still hang on? We don't know the answer to that, and perhaps they don't know the answer to that. So there's that uncertainty. But you talked about tech stocks, how growth stocks did so well because rates were so low, and they make money. So that big tech, mega tech, make a lot of money. They are the best of breed, I'd have to say, in the world, actually. But the fact remains that we're seeing a broadening in the market. We've seen that for some time. We like that. That's called breadth. You don't want 4 stocks leading the market higher. That's always a signal that it could be dangerous. So we're moving out. But I'm looking at it, as are many people, and saying they had great earnings, and yet the market didn't do anything, right? These big names just sort of sat there, and the share price just went down a bit. At some point, these are stocks you want to hold. These are stocks that you want in the portfolio. And so at some price level, the valuations come down. I think you're going to see investors, not necessarily traders, but investors come in and add them back into portfolios as that rest of the market broadens. And you do want it to broaden. You don't want the market. You know what we had? You know what kind of market we had for so long? It was the big mega tech names, the FANG names. And then there was a desert in between. And then we had soup, Campbell's soup, we had Clorox, we had Spam, Hormel, that delicious Spam, Hershey chocolate, because we were all eating so much. So look at the two, one side and then the other side. And this was the sign of health in our economy and in the market. We started to broaden it. We started to have housing related names, financials. We had consumer-led names, industrial names, all starting to participate, small and mid-cap, participating and doing well, all signaling that investors see normalcy coming sooner than anyone predicted. And that's a good thing. There's a lot of catching up, as I think you said. A lot of those names were pummeled. No one ever thought you'd be on a plane. No one ever thought we'd be in cruises going to Las Vegas, and it's happening. Right. And that's how we invest. And we were looking early at casino names. We were looking at airlines. Look at the Jets ETF. I mean, it took off, so to speak, before we were, even thinking about booking travel.
Quincy, we have about a minute to go. And I just want to say to you that you are basically the godmother of this podcast, because the inspiration of this podcast was a session you did with our clients a year ago. Oh. We had about 200 of our clients on that. Yeah. And the feedback we got then was remarkable. And they all said, you guys should do this all the time. So I just wanted you to know in a very direct way, you are certainly responsible for Dominick and I creating this show. And we cannot thank you enough for the time you gave us again.
No, thank you. It's important. Again, we have to understand the economy is not the market. And when we look at the market, we want to say, what are we looking at ahead? What's in front of us? And you know what? In front of us is maybe my spa bathroom gets finished and I sell my house and, I send you a postcard. That's what.
We're hoping, but don't retire yet, Quincy. We need you.
Quincy, I want to second. I want to second everything Mike said, but add to it that it was your inspiration of being able to explain these things and these ideas to our clients in a way that was just common sense and it was logical. Really was the inspiration for us to do this show and continue to do this show. I can't thank you enough for
your heart
and going forward.
Bless your heart. I'm going to say this before we go. I said on your show, I said, all my husband and I want to do is go to the neighborhood pizzeria, sit inside and have our meal and have a glass of wine. I said that on your show. We weren't thinking big. Now we're thinking big. But then that's all we wanted to do, and we can. So we've made progress. Thank you so much.
So look forward to the future. Thank you.
Ciao.
Good night.
Ciao.
Bye.
Thanks for tuning in to the Lebenthal Report. Dominick, Michael, and Jordan will be back for our next program, airing next Tuesday at 2 p.m. Pacific Time and 5 p.m. Eastern Time on the Voice America Business Channel. Until then, have a great week.